Hey everyone, welcome back to another dividend investing video. If this is your first time with us, we're all about dividend growth investing as a means to build passive income. This is my first video back after my summer vacation and enjoying some time with family, but one thing I've not taken a break from is buying high quality dividend growth stocks. The markets have been unpredictable lately, but my dividend income is growing with each and every purchase. Today, I'm going to share with you 4 dividend growth stocks I've been buying myself in the month of July. A couple look cheap, and a couple are what I like to think of as quality businesses at a fair price. All have solid histories of growing their dividends, and in my opinion are all well positioned to continue doing so for the next decade and beyond. So let's get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first company I'm buying is UnitedHealth Group, ticker UNH. UNH is a Minnesota-based diversified healthcare company. They're the largest healthcare company in the world by revenue. It would be safe to call them a healthcare empire at this point. They are an incredible story of earnings and free cash flow growth over the last decade. Year to date, shares are down 10.75%. Shares began to drop after CFO John Rex made remarks back in June due to the challenges the company is facing due to Medicaid determinations, PBM security, higher utilization trends, and shifting market preferences. The entire industry has been down with UNH. Over the last 10 years, though, an investment in UNH has performed extraordinarily well. Almost 700% total return. You can compare that to the S&P 500 total return of 222% over the same time frame. So UNH is a beast. The current PE of 18.1 is lower than the 5-year average of 19.8. So while the company is historically on the pricier side, we can get it today for a good valuation relative to itself. And shares are yielding 1.62% at the time of publishing, and this is 16% above the 5-year average. Simply Safe Dividends rates UNH with a dividend safety score of 99, very safe. The dividend makes 29% of forward earnings and 23% of forward free cash flow, so no concerns here with dividend safety. UNH has a 13-year dividend growth streak, in addition to 30 years of dividend payments without a reduction. And for a small dividend, its share grows quite rapidly. Over the last 5 years, the dividend has grown at an average rate of 17% annually over the last 5 years. The latest dividend raise announced just last month was at 14%. UNH pays out quarterly in the months of March, June, September, and December in the amount of $1.88 per share for a total annual payout of $7.52. Lower yielding stocks like this may not be for everyone, but take a second to look at this 10-year yield on cost chart from Seeking Alpha. Now, if you purchased 10 years ago, the yield on your initial investment would be about 11%, and that is the power of dividend growth and a business that's consistently growing its earnings and free cash flow. Now, UNH is covered by 26 analysts who give it an overall rating of 4.42 out of 5, rating it a buy. 15 rated a strong buy, 7 a buy, and 4 a hold. The average analyst price target for UNH is $573.38 per share, representing 24% upside from where shares are today. So I feel good adding to my own position at this juncture. And I started buying heavier into UNH last month in June, continuing to buy it here in July. This is the perfect blue chip stock with high dividend growth and market-beating price appreciation. So I'm going heavy on it for 2023, and I recommend using a brokerage that allows for fractional shares such as Fidelity. So that $460-ish price tag really is meaningless at that point. Okay, the next company I'm buying up in July, it's Vici Properties, ticker VICI. Vici is a real estate investment trust that owns one of the largest portfolios of gaming, hospitality, and entertainment destinations. World-class resorts such as Caesars Palace Las Vegas, MGM Grand, and the Venetian Las Vegas. It's not hard to see the appeal of owning a piece of these iconic properties, but make sure you understand the implications of investing in real estate investment trusts, which we talk about all the time on this channel. Now, shares of Vici are practically flat over the last 6 months. Not a lot of drama around this one recently, which is good for accumulating. And they've only been around since 2016, so they don't have a 10-year history to go up against, but we can look at the 5-year history versus the S&P 500, Total returns from Vici have outpaced the broader market 127% to the S&P 500 72%. That's total return. So we've identified one that is beating the market. Now from a valuation standpoint, I think Vici is fairly valued. Its price to adjusted funds from operations is 14.8, which is right in line with the 5-year average. This is a company I'm happy to buy at a fair price as I plan to hold for the next few decades and hopefully beyond, right? Now from a dividend yield theory perspective, I'm seeing the same thing, fairly valued. Shares are yielding just a tad under 5% right now. It's right in line with the 5-year average. And I think this 5% yield is safe at this time. The dividend makes up 73% of adjusted funds from operations. And remember, we look at REITs a little different. We don't look at earnings. We look at adjusted funds from operations. We have a Simply Safe dividend score of 50, borderline safe, putting it in the riskier group out of my typical investments, but it's a high conviction stock and company for me. And I think the low score has a lot to do with the fact that Vici's revenue, most of it comes from just a handful of tenants. That's something to keep in mind. From a dividend growth perspective, again, Vici lacks the track record, but it's off to a wonderful start. We have a track record of 4 years of dividend growth, with the latest raise announced at 8.3% increase over the last. We should be getting word pretty soon on their next raise. I expect the one for their coming October payment is going to be an increase. We'll let you know when that's announced, so be sure you're subscribed. And hit that notification bell to stay up to date. Now, Vici pays out quarterly. Their latest payment came out at 39 cents per share. It's paid in the months of January, April, July, and October. The total payout is $1.56 per share annually. But again, we expect this to increase, and word on that to come out in the next month or two. In their short history, they've been doing a wonderful job growing their AFFO and free cash flow. And this is a per share. We know that REITs often are issuing shares to raise capital, so this is super impressive growth. I think that they're really just getting started. The average analyst price target for Vici Properties is $37.58, which represents over 18% upside from where we are today. So you have the healthy 5% yield, above average dividend growth, and some nice upside potential in the coming years. I mean, look, today we're talking about a $30 billion market cap. If I was a betting man, this company could be many times that going into the future. Now, I've been buying this in my Roth IRA. I've added 8 shares to my position in June, and I plan to add more in my Roth this month of July, but I'm also considering adding Vici as an option to swap out with my Walgreens position that I'm unhappy with in the current portfolio I'm building on this channel, because this is one I would like to increase my exposure to beyond my retirement account, so that's up for consideration. I have a video coming out probably next week on what I end up doing with Walgreens. The third company I've been buying in July, it's Starbucks, ticker SBUX. I don't need to tell you what Starbucks is. They make more coffee than anyone else in the world. The Seattle-based coffee chain is worth over $110 billion today. Now, shares year to date at Starbucks are pretty much flat, but over the last 6 months, shares are down about 6%, while over the last year, shares are up about 28%. Now, zooming out over the last 10 years, Starbucks has outperformed the broader market on a total return basis, beating the S&P 500 by about 26%. And this is with Starbucks in a decline and the S&P going up, so this could narrow some. We can either expect to outperform, or it's going to give us market returns with above average dividend growth, and those are my expectations for Starbucks. Now, shares of Starbucks are trading at a 26.6 PE, and this is an 8% discount to Starbucks' 5-year average PE of 29.0. Yeah, it trades at a premium. I was last adding this position back in mid-2022 and had dipped into the 70s, but now its valuation's coming back under that 5-year average, so in my opinion, it's a decent time to add to my position. Now, shares are yielding 2.12%. It's about 5% higher than the 5-year average, so pretty close to being in line. Consider it a reasonable fair value from a dividend yield theory perspective. And it looks like a safe dividend. I can't see Starbucks cutting it. It takes up 56% of forward earnings, 65% of forward free cash flow. We have a Simply Safe dividend safety score of 67. It's considered safe. Starbucks has been paying this dividend for 12 years, and it's been growing it each and every year. The latest raise was an 8.2% increase from the last, and the 5-year average annual dividend growth rate is at 14%. We'll learn of the next increase that is set for November here in the next few months. And of course, we'll let you know. The qualified dividend paid out quarterly in the months of February, May, August, and November in the amount of 53 cents per share for a total annual payout of $2.12. You're going to have your shares by August 10th to get that next dividend payment on August 25th. So you do have some time there. Now, a couple more green flags. Notice this first graph here, the shares outstanding. sloping downwards. Starbucks has been buying back their stock, reducing outstanding shares from 1.52 billion in 2013 to 1.15 here in 2023. And on the other side, we can see their growing annual revenues, growing from 14.9 billion in 2013. And over the last 12 months, that's been at 34 billion, almost triple the revenue from 10 years ago, growing every year except for that 2020 outlier. And we all remember what happened in that year. Now, the average analyst price target for Starbucks right now, $114.86, representing about 15% upside from where shares are today. Starbucks has had a nice year. I'm up on my own position, but with the dividend payment coming up for August and the stock taking somewhat of a dip over the last quarter, I thought it was a nice time to add a couple shares to my position. I bought it again for the first time in 11 months on July 11th. I added a share to my Robinhood account, and I plan to add another 2 before the ex-dividend of August 10th. It's not cheap right now, and I'm raising my cost basis, so I'm not going to go heavy on it, but it is a high conviction stock for me for the next decade, and it's high enough that I wanted to increase my position some. If Starbucks was to really start dropping, let's say it goes below $90, then I'm going to add a few more shares. I'm very bullish on this company's future. The final stock I'm buying will be continuing to buy in July. BlackRock Inc., ticker BLK. BlackRock is an American investment company. Today it's the world's largest asset manager with $9.09 trillion in assets under management as of April 14th, 2023. They manage the iShares ETFs. You may own and hold some of these yourself. Now, over the course of 2023, shares have mostly traded flat for BlackRock. But zooming out over the last 10 years, we have a total return of 238%. And this is a slight improvement on the 222% brought in from the S&P 500 during the same time frame. We have a market-beating company with above-average dividend yield and dividend growth. From a valuation standpoint, shares of BLK are trading at a 19.6 PE, right in line with a 5-year average, suggesting it's around its fair value today. And shares are yielding 2.82% today, which is a tad above the 5-year average of 2.71%, looking fairly valued from a dividend yield theory perspective. The 2.82% yield looks safe. Payout ratios a little more elevated than normal, but not too concerning at 55% of forward earnings and 50% of forward free cash flow. And BlackRock gets a dividend safety score of 98 from simplysafedividends.com, rating it very safe. Solid rating for a financial stock. These get higher scrutiny from this site, and deservingly so. BlackRock features a dividend growth streak of 13 years and an uninterrupted streak of 19 years. The dividend was maintained in the last recession, and during recessions, it could be expected that BlackRock is going to be affected quicker than other companies due to its position in the financial industry. And we're seeing this now with its latest dividend raise being considerably lower than its normal, right? This is due to the economic situation. And other asset managers such as T. Rowe Price have been doing the same thing. So its latest raise was only about 2.5%, while its 5-year average dividend growth rate is in double digits. The dividend is paid out quarterly. The qualified payment of $5 per share is paid out every March, June, September, and December, bringing the total annual payout to $20 per share. Shares outstanding have also been on the decline, going from 174 million in 2013 to 152 million in 2023. That is a 12.6% decrease in outstanding shares over the last decade. Nice. All right, so the average analyst price target for BlackRock is $786.47. This represents almost 11% upside from where shares are today. So perhaps we have some upside ahead for this stock as well. For me, investing in BlackRock is such a no-brainer. This is a massive player in the overall stock markets, one of the so-called Big Three index fund managers along with Vanguard and State Street. They carry a tremendous amount of influence. And I definitely consider this one of my current top 5 buy and hold forever dividend stocks. I think it's another one where the relatively high share price is off-putting to some retail investors. But again, fractional shares are your friend with this one. Alright folks, those are my top 4 stocks I've been buying in the month of July. Of course, buying SCHD as well as others. I guess you could say the theme I'm going for this month is quality over cheapness or value. I think with the markets being up, there's less things on sale, and healthcare is still looking cheap right now. But I'm looking to invest in more than just healthcare, so that's why I'm also gravitating to the higher quality, fairly valued companies like the Starbucks and the BlackRocks. Okay. Now, thank you so much for sticking around. If you want to follow my public YouTube portfolio and see how we did in the month of June, the dividends we received, just click here into this next video. And I hope you all have a wonderful day. And until next time, keep investing.